Africa, rich in critical resources, is fast becoming the Gulf's next big investment destination. After Saudi Arabia and the UAE, now Qatar has stepped in with one of the biggest investment announcements yet. Qatar has unveiled a massive $103 billion investment plan across 6 African countries. The package signals how Africa is becoming a critical arena in global competition for minerals and markets.
It's a big chance for all the entrepreneurs, all the startups around the world to allocate here in Qatar. We have a very advanced education system. We just announced $1 billion allocation of startups to invest in venture capital. Qatar is the only country where you have 5 legal frameworks to establish your businesses. There is Ministry of Commerce, Qatar Financial Center, Qatar Science Technology Park, Free Zones Authority, and there is Media City. The talent and the diversity in Qatar is, as soon as this example, you can hire anyone from anywhere in the world and they can come here.
In 2025, a dramatic financial shift unfolded. From Doha to Kinshasa, from Lusaka to Maputo, one of the world's smallest states in landmass began making one of its largest economic statements. Qatar, a nation of fewer than 3 million people, has pledged over 100 billion United States dollars in new investment across Africa. Some analysts project that the figure could rise toward 150 billion United States dollars, triggering questions about what this means for the global financial map and for the long-standing dominance of the US dollar. Tonight, we explore where this money is going, why it matters, and how it may reshape economic power in Africa and beyond. In August-September 2025, Qatari-linked conglomerate Al Mansur Holdings announced investment commitments totaling approximately 103 billion United States dollars across 6 African nations: the Democratic Republic of Congo, 21 billion United States dollars Mozambique, 20 billion United States dollars Zambia and Zimbabwe, 19 billion United States dollars each and Botswana and Burundi, 12 billion United States dollars each. Qatar's sovereign wealth fund, the Qatar Investment Authority (QIA), with an asset base of over 500 billion United States dollars, provides the fiscal firepower. These deals span critical minerals, energy, agriculture, infrastructure, and transport, sectors that Africa has long highlighted in its quest for growth and sovereignty. For Qatar, the motivations are multiple: diversify away from hydrocarbon dependence, secure access to strategic resources, and expand its global economic footprint. In the simplest terms, Africa is both the destination and the strategic tool. Why has Qatar turned to Africa so decisively? First, Africa offers what Qatar lacks: vast arable land, abundant labor, freshwater resources, and a trove of critical minerals such as copper, cobalt, lithium, and rare earths. Second, African economies are hungry for capital. The African Development Bank estimates a financing gap of 4 trillion United States dollars annually for Africa's infrastructure and development goals. Third, geoeconomics matter. With Washington and Beijing jockeying for influence, Qatar is positioning itself as a broker of economic opportunity and political relevance. In short, Africa is strategic for both economic return and geopolitical leverage. The implications for the US dollar are nuance-laden but profound. The dollar has long been the world's default. Global trade is denominated in USD, reserves held in dollar assets, and strategic partnerships tied to American financial dominance. When countries shift large deals away from the dollar, choosing local currencies, resource-backed units, or alternate settlement systems, the reach of Washington's economic leverage may diminish. If Qatar's Africa investment drives regional trade in non-USD terms, or deepens resource for infrastructure models outside traditional dollar frameworks, the long-standing economic architecture could slowly tilt. Yet this is not about a sudden collapse of the dollar. Rather, it is part of a broader transition toward a more plural global financial system, with Africa increasingly at its center. In practice, Qatar's deals are multi-layered. In infrastructure, investments in ports, railways, energy grids, and processing plants. In energy, partnerships in LNG, renewables, and upstream oil, gas. In mining, securing offtake agreements for critical minerals tied to the global energy transition. And in finance, digital payments trails that may circumvent traditional dollar-based systems. These are not purely financial transactions, they are strategic alignments, and they carry implications far beyond profit margins. But ambition meets real-world resistance. Currency volatility, weak governance, security risks, and legacy debt burdens persist in many host countries. Moreover, when an investor labeled external moves at this scale, questions emerge. Who benefits? Who controls? Are terms transparent? Analysts note that despite the headline $103 billion United States dollars pledge, actual disbursements may lag. Furthermore, non-USD trade systems require depth, trust, and infrastructure that take time to build. For the US dollar, decline is not guaranteed, but challengers gaining traction matters. One key takeaway: Africa is not mere stage scenery. African governments are negotiating, setting terms, and picking partners. Some seek diversification from a Western-dominated model. Others aim to integrate Gulf capital into local value chains. When a state in Lusaka or Kinshasa signs a protocol with a Qatari firm worth 19 billion United States dollars, it is not passive, it is strategic. This is about rewriting investment rules, regional trade flows, and economic leverage. In that sense, Africa may be shifting from a receiver of capital to a driver of capital. Looking ahead, three broad scenarios emerge. Scenario A: gradual diversification. African trade increasingly shifts to local currencies and resource-backed systems, reducing but not eliminating dollar dominance. Scenario B: accelerated alternative systems. Qatar and other Gulf investments integrate into new value chains and settlement systems, creating a meaningful non-USD axis in African trade. Scenario C: reinforced dollar order. The US adapts, deepens alliances, digital dollar platforms expand, and the dollar retains its primacy with lower share, but strong base. Which path unfolds depends on execution, trust, institutional frameworks, and competition. For now, one fact remains: Africa's financial relevance to global power is increasing, and the dollar's era, while far from over, faces evolving competition. From Doha to Dar es Salaam, from Doha's investment pledges to African boardrooms, a new economic story is being written. Qatar's huge Africa push is not simply about capital. It is about influence, connectivity, and parity. For the United States and the dollar, it is neither defeat nor withdrawal, but adaptation. In this interconnected world, power shifts often happen quietly, through deals, alliances, and trade flows, rather than warfare. And as Africa rises, its choices matter, not only to its citizens, but to every economy on the planet. This is Africa's moment of economic agency, and the world is watching.